Is an independent US central bank now on death row? This is Macro Matters, and we're talking about the Fed, where the Fed Chair Powell is fired next week, forced to resign in 6 months, or allowed to muddle through to the end of his term next May. Supposedly sacred idea of Fed independence has already been shattered. President Trump's attacks on Powell for not cutting interest rates has been persistent, but mostly without consequence, and the markets are holding resiliently higher. So what would a politically captive Fed look like? Gregory Daco is chief economist at EY Parthenon. So Gregory, if markets started to believe the Fed is taking its cues from politicians, what would be the reaction?
Well, I think the reaction would paradoxically be one that would be adverse for the U.S. economy, because essentially the loss of Fed credibility would put upward pressure on long-term yields and would also pressure the risk premium, which would further increase long-term interest rates as a result of expected higher inflation and growing concerns around fiscal dominance and a fiscal trajectory that is increasingly concerning. So paradoxically, this could actually hurt the economy rather than help it.
Trump has demanded that the Fed lower their target rate to around 1 to 2%, a major adjustment. Surely such a drastic reduction would hurt the economy.
Yeah, what we are seeing right now is a monetary policy that is slightly restrictive, and the message from most policymakers is that essentially that moderately restrictive stance is necessary, essentially, to combat any risk of inflation reacceleration. If we were to see monetary policy ease significantly with the Fed funds rate cut from above 4% to, say, 1%, that would stimulate higher inflation expectations, and it would lead to a risk of inflation de-anchoring to the upside, which would be a big hit to consumers and businesses around the US, and in turn weigh on economic activity.
Isn't keeping rates artificially low counterproductive to the White House's goal of lowering long-term borrowing rates for Americans?
That's really the key question. I mean, the idea underneath the political pressure to ease monetary policy is that it would stimulate economic growth. But paradoxically, an environment where investors believe that the Fed has lost its independence and that it is increasingly politicized would actually put upward pressure on long-term yields. And we know that long-term interest rates are the main basis of lending for businesses and for consumers. So if long-term rates were to actually rise as a result of this pressure to lower the Fed funds rate, that would be counterproductive in terms of economic activity.
As well, the risk of persistently higher inflation is the reason why rates have been on hold. So will this problem persist even with the new Fed chair next year?
I think we have to remember that the FOMC is a group that votes on monetary policy. There's no one person that essentially determines the outlook for monetary policy. And even if there were to be a new Fed chair that would be in favor of easing monetary policy, that person would still have to convince a majority of FOMC policymakers that easing monetary policy would be the ideal way to go. And I'm not sure that would be the case, given that most policymakers on the FOMC are still politically unbiased and want to do essentially the achievement of the dual mandate of maximum employment and price stability.
Let's look closer at that Fed majority as well. Next year, the committee is adding a few more hawks into the rotation. Is a bigger battle at play for next year, even with Trump's pick at the chair?
Yeah, I think next year is going to be even more difficult to convince the majority of FOMC policymakers to ease monetary policy, unless there is a significant slowdown in economic activity or less inflation than expected from the tariff policy that have been put in place. So there is a key question as to how much easing we will see from the Fed. We continue to anticipate a couple of rate cuts before the end of 2025 and 100 basis points of rate cuts in 2026 on the back of a further weakening in labor market momentum and an easing, a cooling of GDP growth into 2026.
So Gregory, you expect 2 more cuts this year, but do you think Powell will deliver that as well with his remaining few months as chair?
I think Powell will do what's in the best interest of the US economy and the American people. He is very much focused on his role as a policy leader to essentially achieve the dual mandate that were established in the Federal Reserve Act of maximum employment and price stability. And accordingly, he will act and consider the views of other Fed policymakers as to what's best in order to deliver on both of these objectives. And I do anticipate that there will be some further easing over the course of 2025, and that this will be justified by economic factors rather than political factors.
So when are you expecting that first move? Would it be September or December for you?
I think September is the more likely outcome in terms of some easing of monetary policy. We've heard from different policymakers that they are open to some further easing. There is also a rationale that has been argued by Governor Waller that I greatly agree with, that essentially in an environment where inflation expectations are still well anchored, where there are strong disinflationary currents on the services side, and where tariffs are expected to be a one-time shock and not have second round effects, especially in a weak labor market, that there is room to essentially move monetary policy from slightly restrictive closer to neutral.
That was Gregory Daco of EY Parthenon. Don't forget, you can watch more videos on Reuters.com.